Good afternoon. Thank you for joining the Tuesday, March 31st, 2015 edition of Ask the Experts. I'm Chris Grams with CME Group. I'm joined by two grain and agricultural experts who will be sharing their insight on today's USDA reports. At the far end of the table, Dr. Bill Tierney, Chief Economist of AgResource Company, which is a domestic and international agricultural advisory. He's an esteemed economist with more than 30 years of experience researching, modeling, and forecasting commodity prices for wheat, feed grains, oilseeds, and biofuels. Thanks for joining us today, Bill. Joe Vaclavik is sitting to my immediate left. He is the owner and president of Standard Grain. Joe provides management and consulting services, risk management and consulting services to grain and livestock operations throughout the U.S. And Joe, thanks for joining us again as well. We have a few very important USDA reports today, not least of which the prospective planting reports, which the trade has been eagerly anticipating. Before we get to our experts, I want to remind our viewers who are watching online that you can submit questions in that box directly below the video you're watching right now. So please submit any questions you have for our experts, and we'll make sure that they have a chance to answer those for you. At this point, Joe, I thought we would start with you and maybe have you share a couple of the highlights from today's reports. I know the market has digested those reports that came out at 11 a.m. Central Time today, but were there any surprises, any highlights that you would highlight for our viewers today?
Well, the general theme here, as far as the stocks are concerned, to start there, would be larger stocks versus last year and some historically burdensome stocks. Corn stocks up 10% from last year, soybean stocks up 25% from last year, wheat stocks up about 6% from last year. Out of those numbers, the corn number was really the only one that came in well above expectations. We had priced in larger soybean stocks and larger wheat stocks, but the corn number, as high as it was a little bit of a surprise. Also, a couple of shakeups in the acreage. Corn acreage came in at 89.2 million. That was about 500,000 above the average trade guess, actually the lowest number in 5 years, but still a little bit above the average trade guess. Soybean acreage below the average trade guess at 84.6 million. We had looked for a number closer to 86, so a little bit of a friendly number there. Total wheat acreage mostly on par with expectations and came in at the lowest in 3 years. So a couple of minor surprises here. The biggest take home, I would think, would be that corn stocks number, though, might be the biggest surprise in all this.
Bill, how about you? Anything that you saw of particular interest in today's reports?
Well, over the last 5 to 6 years, the corn stocks number is the one that has really thrown the market a curveball. And this year, even though stocks were 1.5% above the average of industry expectations, last year it was 1.5% below. The year before that, 7.33% above expectations. Year before that, 2.3 below. Year before that, 2.7 below, 2.4, and on and on and on. So you go into these stocks reports, and it could happen again with the June stocks report. You go into these corn stocks reports expecting the number not to match up with industry expectations. Now, typically what happens in the April WASDE following the March stocks report, if the stocks number is significantly above or below expectations, let's say by more than 0.5%, USDA tends to adjust feed and residual. It's not guaranteed, but they tend to adjust it, and there's a fairly good statistical relationship. So depending on which industry survey you use, it looks like stocks were about 117 million bushels above the average of expectations. Now, according to one model, that would suggest that USDA in the April WASDE could lower feed and residual, annual feed and residual, by 50 to 75 million bushels. Now, they could leave it unchanged, and they have in past years. They could leave it unchanged because they could be saying that ethanol extraction rates is rising, therefore there's more corn available for feed and residual. They could also say that with hog numbers up, with poultry numbers up, there's going to be more feeding that's going to happen, and that will compensate for the somewhat lower feed and residual in the first half of the year. They could also argue that with wheat prices well above corn prices for the summer, that there's going to be far less wheat feeding in the summer months and therefore more corn feeding. So it's not guaranteed, but there is a strong tendency for USDA to lower its feed and residual if the corn stocks number was significantly above expectation like it was this year.
Now, the one other possibility there is they may revise last year's crop higher, if I'm not wrong. That's always a possibility.
Not in the April WASDE, in the May WASDE. They
right. At some point in the future, though, we could have that account for the bigger stocks.
Right.
So clearly, corn stocks is the big story today. Any knock-on effects for soybeans or wheat that you saw in today's reports?
Not necessarily overwhelmingly, no. The results in both the stocks numbers and in the acreage numbers were not shocking. I'd say that soybean acreage number for this year at 84.6 million, a little bit below expectations. That might be the bigger take home. The stocks numbers were just a little bit below expectations for beans. Nothing shocking there. But that 84.6 million, even though being below expectations, is actually still going to reflect the largest soybean acreage ever in the U.S. It's going to be a new record high. So that would be the take home there. In the wheat, the stocks numbers were a little bit below expectations. The acreage numbers didn't shift much relative to expectations. All wheat acreage the lowest in 3 years because of low prices. I think that the wheat market, actually, what we've seen more recently, has a lot more to do with weather and volatility associated with that than it does maybe anything that was on the report today.
Joe, I know you spend a good deal of time speaking with producers and others in rural America. What's on their mind following this report today, or were there any concerns that were really addressed as a result of the report today?
There is an enormous amount of corn and soybeans being stored on farm that's unpriced, and USDA told us that today. On-farm corn stocks were up 12% year over year. On-farm soybean stocks up 37% year over year was the statistic. So I think coming into the report, farmers were worried about that, and I think they're going to be more worried about it after the report, especially with this price decline in the corn market.
Would either of you gentlemen care to comment on how futures markets reacted to the news of the day? Bill, do you have...
corn market was down the most. Soybeans was up. That's kind of surprising because we've tried to model price response following the report, and it's a very muddled picture because you have two reports, one that's a new crop report and the other that's an old crop report occurring at the same time. And so you get a mixing of price effects. But what we found is that prices for corn and soybeans seem to be driven in most years when there's a price response by the corn stocks number. We didn't see that today because we saw a soybean stocks number that was somewhat below expectations, and we saw a soybean acreage number that was also below expectations. So the soybean market ended up in the green, whereas the corn market was well in the red. I think what's most interesting about what's developing in the market is that there is an increasingly negative outlook for soybeans over the next 12 to 18 months. I think this report just confirmed that, plus continuing developments in South America, plus continuing developments with respect to the value of the dollar. The corn market still today is largely a function of U.S. supply and demand. The soybean market, every single year after year after year, increasingly it's a function of global or Western Hemisphere supply and demand. And with the record crops coming on in South America, and in all likelihood, continued increase in acreage next year for South American producers, they're going to follow U.S. producers. They're not going to cut back on soybean acreage. They're likely to increase it slightly. So all we are doing is adding to record global oilseed stocks this year and next year. And since we seem to have a corn balance sheet, which is largely driven by U.S. fundamentals, since we have a reduction in area, since we are largely expecting a lower yield than what we had last year, which was a record, the balance sheet, the ending stocks for corn, doesn't look anywhere near as burdensome as the ending stocks for U.S. soybeans or the ending stocks for global soybeans. So of those two commodities, I think definitely it's oilseeds that has significantly more downside risk than corn over the next 12 to 18 months.
Yeah, I agree that the statistics there and the headlines, like you said, are all very negative when it comes to the soybean market. I mean, record South American production, record U.S. acres this spring, the possibility or probability of record U.S. production, record world ending stocks. It's kind of a scary deal, and it continues to build on itself with the expanding acreage both here and in South America. The corn deal, I kind of agree, and I think that it does have the potential at least to tighten up if we were to have some sort of weather issue here in the U.S. I think that the trend line yield that most of the academics are using coming in this year is somewhere around that 164, 165 bushel per acre mark. And if we were to deviate from that to the downside and say you come in with a number lower than 160, I think that things do have the potential to tighten up quite a bit, whereas the soybeans, where this expanding acreage and expanding South American production, it's going to be a little tougher.
To what extent are you following exports? As you're talking about soybeans, is that a concern, the U.S. export or demand for U.S. soybeans right now outside of the U.S.? Is that a factor that you're watching closely at all?
Yeah, export demand for beans has been fantastic. In fact, I think the total commitment between sales and shipments is already at or above the total USDA projection. So demand is not the problem here. We've got plenty of demand for corn, plenty of demand for soybeans. The problem is supply. This is a supply bear market. It doesn't have anything to do with the lack of demand at this point, because the demand figures across the board are really just fantastic still.
Bill, you mentioned the strength of the U.S. dollar. Is that playing a role at all in the export market?
Well, that's a common misunderstanding in the industry, that if the dollar is up, then U.S. exports have to be down immediately. And there was at least one USDA study that I saw that tried to trace the effect of changing currency values. And the effect is largely in the production side of major export competitors. So our major export competitors are incentivized to sell their exportable surplus when their currency declines relative to the dollar. But the real effect is their planting decisions in the next production cycle. And we've seen that in Western Europe, we've seen that in the Black Sea. We're likely to see it next year in Argentina and Brazil, that their currency has declined so much relative to the value of the dollar that even with sharply lower soybean prices, they're going to respond by likely maintaining, if not increasing, soybean area. So it's not an immediate day-to-day effect, though it does have a slight impact. It's mostly in the next production cycle and how that stronger or weaker currency stimulates increased production in the countries that are major competitors. It's not just Brazil and Argentina, it's also Western Europe, it's also former Soviet Union, it's also Canada, it's also Australia. Nearly every country that's a major exporter of crops is in direct competition with us. Their currency has gone down relative to our currency.
I have some questions coming in from our online viewers. Joe, you mentioned a little bit about on-farm storage, but feel free, Bill, to jump in on this one as well. On-farm corn storage is huge in Iowa and Minnesota versus commercial storage. What does this mean for the efforts to avoid a 2.0 billion bushel ending stocks number?
Well, at some point, the farmer is going to have to sell this grain, and it's likely going to have to occur before this coming fall's harvest. So it's in my opinion, one of the biggest negative price implications that we have with corn right now is that farmers are sitting on a lot of it. Historically speaking, the market has a tough time rallying when farmers are very heavy holders of physical grain, and that's the situation that we're in right now. It's going to have not only futures impact but basis impacts as we move forward. If we get into a situation where weather looks really good in June and July and farmers are still sitting on a whole bunch of last year's crop, the cash market, in my opinion, could get very, very ugly. Now, of course, a weather problem can fix all this and really kind of bail out the farmer, but at this point it's tough to count on that.
Another question here. Any thoughts on what this report could mean for DDGs?
Well, I don't think we're likely to see a significant change in the amount of corn ground for ethanol. It could change by 75 to 100, 125 million bushels, but out of 5.1 billion bushels, that's not a big change. The question is what happens to the DDGs, which is a byproduct of the ethanol production process. China had been the major export market for U.S. DDGs. They have started to pick up their DDG imports, but it seems like sales of sorghum, sales of barley, even cassava, is displacing to a certain extent corn, and also displacing to a certain extent the DDGs that they have purchased in the past. So that could have a negative knock-on effect for U.S. corn feeding next year. If we don't restore the export markets that we've relied on in the past to absorb some of the DDGs production, it's going to be fed here in the United States, and that would directly reduce corn feeding.
What about ethanol? With crude oil taking 50% reduction in price per barrel since last year. You read a lot of reports about consumers now driving more. Has there been any impact to ethanol production?
Well, there are a variety of things that will swing ethanol consumption up or down. One of them is exports. One of them is discretionary blending on the part of the blenders. When they have an opportunity to make a blending profit, they tend to push a little bit more, a very minor amount, a little bit more ethanol in the blend. And certainly producer production margins also have a slight effect by altering the supply that's available. But again, I think it's inappropriate and distracting to look at the ethanol complex, even though it's the biggest part of the demand, and expect to see price significant changes. I mean, the changes are going to be so small and so gradual and signaled that I don't think it's going to be a price moving factor. So like I said, you could take the 5.1 billion bushel number and either add 75 to 125 million bushels or take that away. And I don't think it's going to have that big of an impact on the corn market, certainly not on futures. So I wouldn't get distracted with that. The portion of demand which tends to have an impact on the market is one of the smallest, and that's ethanol. And even though it's one of the smallest, not ethanol, exports, even though exports is one of the smallest, it tends to have a disproportionate impact on the market. So if you're trying to get a handle on what's going to happen to the corn market over the next 4 to 5 months, it's not going to be ethanol. It's going to be planning progress over the next 6 to 8 weeks, and then it's going to be yield expectations up until early to mid-August. And then after that, pretty much your corn pie is baked. Once we get that yield, we're not going to see large deviations in consumption. Once we get that yield number down, we pretty much have a fairly well-known price horizon for corn.
And ethanol, margins for ethanol producers during the last couple of months have not been great. They've been break even to maybe even negative in some cases, but we've still seen production week to week maintain a lot of strength. So I don't, like Bill said, I don't think it's going to be a huge issue moving forward. And in fact, if prices do continue to trend lower or remain under pressure, that may be a good thing for ethanol margins overall.
Okay. We've got some more questions coming from online viewers. There was talk of feeding more wheat than corn. Does this report change that idea?
Well, there's an idea here that the feed and residual use number in corn is going to come down. Was some of that taken away by wheat? I don't know. We don't know that yet. I think it's a possibility, though. I think I suppose you could make that argument, especially with the wheat stocks number coming in a little bit lighter. Maybe that's possible. We'll find out in the next couple of USDA reports.
Bill, you have a fan online. This question is for Bill. Outside of a weather problem in the U.S. this growing season, even a slightly below trend yield would still give us a stocks build. What is to stop soybean prices from going lower?
Obviously, weather. The largest risk factor in crop markets is weather. The second biggest risk factor is policy. If we were talking about corn, we could talk about Chinese corn import policies, but we're not. We're talking about soybeans. China's not going to alter their policies that determine their soybean imports. Europe is not going to alter their policies. So I see the only thing that will drive soybean prices higher is significant weather events, sharply reducing yields in North America, and probably requiring a short crop in South America as well. Because if you get, let's say, a 38 bushel soybean yield here in the United States, all that's going to do is sharply drive up South American acreage. So the rally would last probably 6 to 8 weeks. And then the market will have to factor in perhaps anything like a 7 to a 9% increase in soybean area in South America. There's a potential for an El Nino this year. I've seen that as much as a 50% probability. Now, some people may say that that's a flip of a coin, but El Nino probabilities in any particular year are somewhat less than a third to a quarter. So a 50% probability is significantly greater than average. Oftentimes, El Ninos are associated with favorable yield outcomes with regard to South American soybeans. So the only thing right now that's most likely that would drive soybean prices higher or stop them from going lower is significant weather problems with both the North American and probably even the South American crops. And I'm not willing to call that right now.
A couple more questions from online viewers that we want to get here too. This was a follow-on to the earlier question on on-farm corn storage. Will we see now more soybean acres as farmers feel this corn lump in their throat?
That's possible. The USDA does their survey during the first couple of weeks of March. I think that with the December corn contract down around that $4 area, you're probably now in a price level or price territory that is unprofitable to produce corn for a lot of growers, and we were teetering on that edge even with higher prices prior to today. So yeah, I think that today's report could potentially result in some increased soybean acreage and lower corn acreage relative to the USDA estimate, but it's got to be said that weather is going to play a huge role in that. Are farmers going to be able to get in and do what they want with the corn or take a step back? Weather is oftentimes kind of the make or break deal when it comes to what gets planted, and it's always easier said than done when it comes to shifting acreage around. But yeah, the implication would be after today, maybe a little less corn, maybe a little more beans.
Yeah, and interesting weather has come up quite a bit. And Bill, you mentioned the chance for some El Nino. Are you watching any longer-term weather forecasts or reports that may have any clue about what planting weather will be like over the next several weeks?
I will pay attention to the longer-term forecasts, but they are largely inactionable. When the weatherman tells me if it's going to rain in my house tomorrow, then I'll just start to subscribe to some of the longer-term weather outlooks. But no, I don't think that it does any good from where I sit. It's stuff that's fun to talk about, but largely inactionable, in my opinion.
We think that in the northern plains, the lack of snow cover compared to past years increases the likelihood that preventive planting could be down from previous years. That might increase slightly spring wheat acres, a little bit of corn acres, possibly a little bit of bean acres. Overall, any differences between the June acreage report and the prospective plans report that was released today, any differences that are observed are almost entirely attributable to planting weather. If you have early planting, you tend to get the corn acreage that we farmers intended, maybe even a bit more, and sometimes you see just a little bit decline. If on the other hand you get significant delays in planting, then corn area tends to drop, soybean area tends to pick up. So it's way too early, I think, right now to expect anything other than what farmers intended. But let's say in another 3 to 4 weeks, again, if it looks like soils are warming up and continues to be dry, then we might say planting might be a little bit quicker than normal.
Fair enough. Question about corn yields. Many are using 166 projected yield for this year's corn. However, that's much above the past 7-year average. Would sub 160 be a better guess?
No, I think that you can leave that to the academics, and most of them that I've seen are between 164 and 166. I think it's a fair starting point. I think that a number below 166 is certainly possible. I don't know if I can make the argument that yields have plateaued after last year, where we had a new record high yield. So I think that that's kind of off the table following that. But yeah, I mean, if you punch that into a balance sheet and you punch in a 155 or a 157, and you use kind of similar demand numbers to what we had this year, you punch in your acreage number that we had, I think you would find things tightening up quite a bit in a hurry. But that, of course, is all just a function of weather, which we've already kind of covered here. You know, if we run into a weather problem, that's going to be higher prices. It's really as simple as that in a lot of situations. I think this year will be no different.
As you both know, at the exchange, we're unable to make any forward-looking comments or price projections, which is why we bring you our experts in, outside experts in. Question here, if you're willing to take the bait. Starting to harvest soybeans in Uruguay and elsewhere in South America. This questioner says, I didn't sell any beans. Will we have any chance of soybeans going up to $10 a bushel in the short term?
Oh, in the short term? $10 in the May futures contract? Sure, that could happen. Any combination of factors could do that. But I certainly wouldn't make that my marketing plan. If you haven't sold any soybeans at all out of the crop that you're harvesting now, if you were doing that because of a foreign exchange projection, obviously you've made money. I have no idea what the Paraguay currency is doing. I assume since Argentina and Brazil are its major trade partners, it's going down as well. So clearly not selling and counting on their foreign currency, their currency to go down, was a smart move. But I wouldn't hang on to the expectation that May soybeans, July soybeans is going to stay in the $10 range. I think that we're likely to see the July futures contract dip below the $9 level, possibly even the mid $8.50 level before the July contract goes off the board, assuming normal weather between here and early July.
We have, following in Asia, some individuals who sent me some questions in advance that they would love for you guys to address if you have a perspective. What are your forecasts on the grain crops in India and China this year?
India's had some weather issues. They've had a very wet month of March, and I think that the general idea here is that we may see the wheat crop back off a little bit relative to previous expectations. So I think that's kind of the one thing I'm following. I'm not necessarily an expert on overseas production, but as far as India goes, that's what I'd say about that. They have had some weather issues. Still could be looking at production close to record though.
Bill, any thoughts on China?
China's a black box. We had a program in Geneva last week where we had one of the China analysts from USDA speak, and he pointed to some data that suggests that Chinese corn yields were actually increasing. There is significant room for Chinese corn yields to increase relative to other major corn producers like the United States, Western Europe, and even the Black Sea. And he was suggesting that the data suggests that yields are increasing. Part of that reason is because plant populations were going up, and that's where the data suggested that increased yields that are being reported by the National Bureau of Statistics are supported by field observations that counted more plants per hectare. Right now, it's I think the wheat crop is the wheat crop, whatever that is. The corn crop, it's way too early to say that production is going to be significantly above or below last year's production. Whatever it is, China's feed imports next year have almost nothing to do with their production level. It has everything to do with whether the government is going to permit the import of feed substitutes. If they don't want to permit the import of feed substitutes because they're rapidly building to a burdensome level domestic stocks of corn, then they're going to find something wrong with U.S. corn imports. They're going to find something wrong with imports of DDGs. They'll find something wrong with imports of barley. They've done it before in the past. They'll find a phytosanitary objection, and they'll cut off the imports of these feed substitutes. It's basically a question of whether the government wants to permit the continued import of feed substitutes. Almost 18 million metric tons this year, possibly a record 19 million metric tons next year, while they're still at the same time building domestic corn stocks and have corn prices more than twice as high as the world level. It's all policy. It has nothing to do with weather.
Follow-on question to that, do you think Chinese exports of soybean meal in 2014 is a one-off, or do you think it will resume this year? And how could that affect the price of edible oils?
Relatively speaking, if I'm not mistaken, China's a very small exporter of meal. They are the world's biggest user of meal. I don't see that statistic changing a whole lot. Relatively speaking, I think they'll continue to kind of be a net. I mean, really net, they're kind of not a big exporter or importer, am I right?
I think they have about 2.5 million metric tons of soy meal exports this year. Part of that was supposedly they were taking advantage of markets in Southeast Asia that could no longer get the meal that they wanted out of India. Again, China's agricultural sector is a black box. What's really important is who is making those exports. Are they coming from state-owned enterprises, or are they coming from private sector companies? There is suspicion that state-owned enterprises are either directly or indirectly subsidized by the government. We know that China has crushing capacity far in excess of their annual crush. We know that they're trying to rationalize the industry by bringing about economic forces that shut down small, inefficient producers. What we don't know is are state-owned enterprises importing soybeans, crushing for the oil, because China is the world's second largest vegetable oil importer. Every pound of vegetable oil that they can get their hands on, they consume. And is it possible that to take advantage of their crushing capacity, that they've been expanding in the state-owned enterprises, would they subsidize the import of soybeans, crushed for oil, and then if the domestic meal price isn't profitable, then sell the meal in the international market? It's possible if you're a state-owned enterprise and you're getting some kind of indirect or direct subsidies from the government. Nobody knows whether that's occurring, but it could be occurring, and it could be one of the factors that might promote soy meal exports.
Joe, you mentioned a little bit about India and wheat earlier. One of the questions we have is, will India become a bigger exporter of wheat this year? And by way of background, the questioner says India was a regular exporter of wheat from 2000 to 2004, stopped from 2005 to 2011, and then resumed exporting in 2012 to today. So any anticipation of them becoming a bigger exporter of wheat?
Exports projected to be a 4-year low this year. World supplies of wheat are ample right now. A lot of people would say we have a supply glut of wheat, and I think that because of some of the weather issues that they've had potentially, they are likely overpriced on the world market, so their exports suffering a little bit. Wheat imports into India actually at a 5-year high, so I think that perhaps maybe some of the weather issues that they have there are kind of adjusting that, but exports actually suffering quite a bit here relative to the last few years.
And the last question, I think that we have covered pretty well in Bill's comments on the Chinese ag sector, but there was a question about Chinese corn production forecast for this year. Will we see a return to Chinese corn exports? If so, how would that affect prices? I think, Bill, you've kind of touched on that already in your comments on the...
Well, my understanding from conversations I've had with people who know far more about China's WTO accession agreement is that because of their domestic price support programs, that predominantly through the reserve purchase program, China to export corn would be strongly challenged by the United States. That doesn't mean that China wouldn't do it, but that it would be almost immediately directly challenged by the United States as a flagrant violation of the WTO accession agreements. Could China, through VAT tax refunds, through transportation cost waivers, because the railroads are all owned by the state, could they subsidize the export of corn byproducts from the corn milling industry in the form of starch and lysine and other products? Yes, they could. So maybe we might see some effort to manage the very large and building stocks by subsidizing the export of corn products, not subsidizing the direct export of corn. But I'm not saying that it won't happen. I'm just saying that most people seem to think that the Chinese government would not directly subsidize corn exports with their prices double the international level.
I appreciate you gentlemen going overtime with us today. We had a lot of questions from our viewers. A very important report today, so I appreciate your time and your expertise. Joe, you kicked us off. Any final words, any final thoughts coming out of today's report or looking ahead beyond today's report?
The moral of the story is that we are in a supply-driven bear market across the grain complex, really. USDA confirmed that today, particularly in the corn, but nothing on the report today was overwhelmingly surprising. I think those stocks numbers for the corn in particular, on the high side, the soybean acreage number a little low, but nothing that we didn't really know already.
Bill, you have the final comment. Anything you didn't get a chance to touch on?
Well, we didn't talk a whole lot about wheat. Wheat prices are essentially set in the Black Sea. That's been the case for the last 7 or 8 years now. Black Sea weather can go either way. We do have large carryover stocks that would certainly cap any rally, but the wheat market's been pounded down quite a bit. Of the three principal crops, soybeans to our view, has the largest downside risk. Corn has the second largest downside risk. And wheat, we're going to have harvest pressure. North American harvest, Northern Hemisphere harvest is anywhere from 3 to 4 months away. But there's some factors out there that would suggest the wheat market doesn't have that much downside risk compared to the other two crops, feed grains and soybeans.
I want to thank our experts, Bill Tierney, AgResource Company, and Joe Vaclavik of Standard Grain. Just a reminder that an archived version of today's discussion will be available on our CME Group TV YouTube channel. That's youtube.com/CME Group TV. Thank you very much.